I'll be presenting today on the agrochemical space and the Indian agrochemical landscape. I'll try to give an industry overview and the players, the kind of value chain that exists in India, and what are the opportunities and those things. And I'll also discuss a couple of stock ideas. So you can follow me on Twitter. It's called the Harsh Folio. It's a bit of a weird name. uh, Going on, this is just a disclaimer slide. So this is just for education purpose. Any trademark that I use is not owned by me. I'm not a registered analyst. I have positions in companies which I'll be discussing. Yeah. So now let's go to the agri value chain. So the first thing that is there in the agri value chain is raw materials. So this can be nitrogen, this can be phenol, this can be benzene, and from those raw materials we make intermediates. So these are generally very niche intermediates, and we have a lot of companies that operate in this space, and this is kind of a smaller market. The next step is active ingredient or technical. So this is similar to APIs that we have in pharma. So these are the building blocks that go into formulations. So this is the main part which imparts a pesticide the power to kill pests. So this is what makes them useful. So these are very highly concentrated chemicals which are made using machines and a lot of heat. And we generally have two kinds of intermediate. One is generic, one is patented. So an innovator, typically these are US or European or Japanese companies like Bayer, Syngenta, FMC, Sumitomo, Kureha, like these kinds of companies come up with new molecules. They figure out what are the ingredients that are active ingredients which are required. They have a typical patent holding period until which only they can sell the product in the end markets. And once once the product goes off patent, then the generic players come in. So India typically has been, most of the Indian companies typically have been generic companies. So just like in pharma, we have generic APIs versus innovator or patented APIs. It's very, very similar in the agchem value chain as well. And in patented molecules, we have two kinds of companies. One are the innovators who actually make new molecules. So generally for creating one new molecule, it takes R&D budget anywhere in between $1 to $2 billion. So it requires a lot of balance sheet strength to create new molecules, and it's also a highly risky venture. And most of the Indian agchem companies do not have the balance sheet size to do R&D of this magnitude. Maybe UPL nowadays has, because it's become it's in the top 5, 6 agchem companies, but apart from that, nobody has that kind of balance sheet capabilities. So a lot of Indian companies just do research and research for the innovators. So this is what PI Industries used to do. So they started this business line when the patent law in India came into force. This was around 2004 and 5. So they promised the innovators that they will never compete with them, but they will do research for them. They will help them in their research. They won't charge them like a contract research fee. So this will be part of their services. And once the molecule is successful, they will be the exclusive or one of the main suppliers of the active ingredient. So they built a very strong entry barrier around their business by being collaborators with the innovators, whereas most of the Indian other generic companies, they used to simply copy the drugs or the pesticides which were going off patent. So PI Industries really mastered this model. Recently, there are other companies which are trying to get into this. So Punjab Chemicals has around 30% of its revenues, which comes from this segment, which is patented molecule manufacturing. But it's still a very high entry barrier business because it requires lots of trust from the innovators. And then most of the other Indian companies are generic AI manufacturers. So once we have the active ingredient, then comes formulation. So this is the final product which the farmer applies in his own farm. So how we make formulations is we have an active ingredient which is super concentrated, and then we need to dilute it, and we need to mix certain inert or non-reactive material to it. So typically formulation is done by small contractors because it's not at all capital efficient. It's not at all capital intensive. So the kind of asset turns that these formulation guys enjoy is 10 to 15x. So it's not capital intensive, and that's why there are lots of small contractors who do this. And finally, once you have the formulation, you package it, and then you market it. So in India, we have two kinds of companies, one with exclusive focus on the Indian market. So these are the companies which sell generic formulations, but in their own brand name, just like we have in pharma. Branded generics, we have something very similar in pesticides market as well, which is branded pesticides. So here we have all the companies like Rallis, Dhanuka, UPL. UPL is much more than a pure domestic company, but UPL is also the biggest domestic agchem company. We have a lot of companies operating in this segment, and then we have companies with global marketing capabilities. So in generics, we have only two players from India. One is Sharda Cropchem, the other one is UPL. And then we have a lot of innovators that are mostly American or Japanese. So these are Bayers, Syngentas, and FMCs or Kurehas of the world. And finally, you sell it to a retailer who then sells it to a farmer. So this is kind of the whole agri value chain in India. And now I'll go into three main segments in this agri value chain. So first I'll talk about the domestic agri-chemical market. So when we talk about domestic agchem market, here are the major players that operate in India. So I'm talking about only companies which are listed. There are a few companies which are also big, but they are not listed. But more or less, these companies make up most of the agchem market in India. So when I'm saying here agchem manufacturing, I'm really talking about pesticide manufacturing, and I'm not including fertilizers or seeds. So I'm really talking about pesticides. So these can be herbicides, fungicides, or insecticides. In the agchem market, the biggest player in India is UPL again. They do around 4,500 crore sales in this. They also have a seed division. If we remove that, I think their sales number is about 4,300, 4,400 crores. And then we have MNCs. So Bayer is one big MNC, Sumitomo. These are the two big MNCs. They launch products that were originally developed from them, and they launched them in the Indian market. And then we have a host of Indian companies, such as Dhanuka, Insecticides India, Rallis, PI, Hiranpa. There are quite a few companies. What I've seen generally is this is very similar to any domestic FMCG business. The only difference is this business is much more dependent on monsoon. So the sale of pesticide inherently depends on how good the monsoon was. And the growth rates, long-term growth rates are somewhere around 10 to 12%. So very in line with nominal GDP growth. This is a branded market. So most of the Indian companies sell generic, but they sell them in their own brands. So this is a branded market, and most of the companies buy the active ingredient from the innovators or from China. So this is very high ROCE business. It has low capital requirement, and it is kind of low growth. So when I say low growth, I mean in line with nominal GDP growth, so 10 to 12%, which is more or less also the volume growth that FMCG companies show. Here, the main growth driver is introduction of new products. So as Indian companies do not innovate, they only launch products in collaboration or through in-licensing with European, US, and Japanese innovators. So this is called the 9-3 route, through which you can introduce new molecules in India. This typically takes anywhere between 3 to 5 years to get an approval of a new pesticide in India. And generally, the active ingredient for this is bought directly from the innovators, and the domestic guy just mixes it, makes it a formulation, packages it, and then sells it through his or her distribution network. Here, there is limited scalability. So most of the companies face scalability issues around 13 to 1,500 crores. And this is what we actually see. Like there are lots of companies in the 1,300 crore kind of range. And the companies which could grow beyond that are really MNCs who could introduce newer molecules, or a UPL, which is a very different kettle of altogether. UPL has a very, very strong hold in the Indian domestic market. So the total domestic market size is around $2 to $2.5 billion. I think the last number was around 20,000 crores a year. And there are almost 10 players occupying a majority, 90% of this market. So sales growth is in line with nominal GDP growth. So in domestic marketing, to make really outsized returns, one has to catch growth very early. I'll give an example of Insecticides India. So Insecticides India is a relatively new company. So they have been operational for about 20 years now. So that's new in terms of their comparison with Rallis, which is a 40-year-old company. So in so they had this golden period between FY 8 to 14 where sales grew very fast from, let's say, around 150 crores to it reached from 750 to 800 crores. So the sales growth of 26% actually also translated into share price growth of 28% during this time period. However, once they reached that 800, 850 crores sales level, the sales growth has really tapered since. And this is a trend that I show you across multiple companies. That is, once you reach that 1,000 crore kind of revenue mark, then the sales growth is much more dependent on the monsoon cycle rather than on your own marketing strategy. So sales growth moderated to 8%. Share price growth has also been subdued since 8%. This has also happened with a Dhanuka Agritech, who has one of the strongest distribution network in India. I think their farmer reach is around 1 crore, 1 to 1.2 crore farmers in India. So they have one of the most extensive distribution reaches in India. So we can see a similar story with Dhanuka as well. Like in the golden period, they grew very quickly from 250 crores to around 700, 720 crores. But once they reached that 700, 800 crore mark, again, the growth kind of slowed down. And since then, like the growth rate has come down. So this is an issue which is true prevalent across companies. That is about the first part of my presentation, which is about domestic marketing. The second part is about active ingredient manufacturing. So here I talk about both generic and patented players. In this, I'll just show you some excerpts of how the growth has looked like. So PI Industries is the biggest player in this. So they have grown very fast from around 1,200 crores in FY16. They did 3,300 crores. This year, they should end up with around 3,600 crores of active ingredient sales, and most of it is, or almost 90% of it is from patented molecules. So this is a very fast growing segment, and this is also a segment where China plus one is happening. So China controls 75% of the global active ingredient market, and India controls about 8% of the global market. And recently there has been supply disruptions. This started happening in around FY18. And since then, a lot of MNCs are trying to change their procurement strategy. So they are trying to have a second supplier or a third supplier. And one of them, they want a supplier from outside China. And this can be seen across players in India. Like FY18 to FY21 growth has been 30 to 50% for a lot of companies. So this is CAGR growth. So a lot of companies, smaller companies like India Pesticides, these guys used to have sales of around 100 crores in FY15. Right now, they're doing exports of more than 400 crores. So the growth has been really spectacular in this part. So this is China plus one playing out. Also, this is kind of a B2B business. The ROCEs that most of the companies make is in moderate range, so somewhere around 20%. Capital requirement is very, very high because you need to establish new plants for making these active ingredient. But the growth is super high in this segment right now. So there are two business models that exist so far. One is a collaboration with a multinational innovator, where you make active ingredients in collaboration with them. So you become their supplier. This is what PI Industries mastered. This is what others like Punjab Chemicals is trying. Aztec is also trying to break through this. Bharat Rasayan is trying. So a lot of companies are trying it because it has very high entry barriers. The other business model is of generic exports. So the molecules which have gone off patent, you can simply sell the generic version of these molecules. And all the Indian companies operate in this space. I've been trying to understand how scalable this business is. So right now, PI Industries is doing 3,600 crore annual exports, and they are growing at 20% plus. So it seems it's quite scalable because most of the other companies are doing around 400, 500 crore sales. So it should be scalable. The total exports from India is around $2.5 billion. So that's around 22,000 crores. And this market is growing, like the sector itself is also growing very fast. So sales growth is very high, 15% plus, definitely much higher than nominal GDP growth. So here I show example of two companies. One is PI Industries. So this is like last 5 years, sales has grown 17%, EPS growth has been similar. Share price growth has been higher because they have become more overvalued than they were in the past. Another interesting example is of Bharat Rasayan. They have actually been growing faster than PI Industries, both in terms of sales and EPS, and it's also reflected in their share price growth. And now a lot of companies have seen this business model, and now they are trying to replicate this to get the kind of success that a PI got. I'll slot this kind of industry in four subsegments. So one is a very highly valued company, such as the PI Industries. They trade at more than 7 times sales currently. Then we have the highly valued companies, so 4 to 6 times sales. In branded terms, these are the FMCG kind of valuations, more than 4 times sales is generally branded valuation. So this is like the Shivalik, Rasayan, Aztecs of the world. And then we have like the fairly valued kind of companies. So these are companies which are smaller right now, and they are trying to find their niche. So these include Bhagirath, Best Agro, Hiranba, Punjab Chemicals. And then we have the cheap guys. So the super cheap ones are Make Money. So Make Money group is also growing very fast, but they have had corporate governance issues in the past. Same was the case with NACL. So this is Nagarjuna. They have been listed for a long time. Recently, there was a promoter change. And since then, things have been improving. Aimco is another company which is kind of a turnaround. So these are the cheap ones. And so my approach so far has been the best opportunities lie in the cheap to fairly valued ones, where we can actually get very high growth rates, but at the same time, we are not paying for those high growth rates. So for me, these are the companies which look super interesting from a stock perspective. Business-wise, everyone is doing very well currently. So now I'll go to the end, to the last part of the value chain, which is global marketing. So there are only two companies which are operational in India, which are based out of India, which do this. One is UPL, which is an absolute behemoth, and growth rate for both has been quite good. Sharda's growth has been based on organic growth, whereas UPL has also been on an acquisition spree. So a lot of UPL's growth is because of acquisitions. But growth is not something to be complained about. There are only two companies in global marketing. These are B2B to C businesses because they supply to distributors in each country, and then the distributors sell it to the end farmers. These are medium ROCE business, but the capital requirement is also not that high because they're not like Sharda doesn't manufacture anything itself. It outsources manufacturing completely, and this is also very high growth. Valuations are very comfortable. A UPL trades at both UPL and Sharda trade at about 8.5 times EV/EBITDA, less than 2 times sales. So the market definitely doesn't like global marketing companies so far. So now I'll talk a little bit about Sharda Cropchem. So they have a very unique business model where all the manufacturing is outsourced, and they spend most of their time in getting registrations in developed markets. So they get registered, they sell in Europe, US or NAFTA, and Latin. And the biggest contribution comes from Europe, followed by Latin, which is the American and the Canadian and Mexican market. These markets are very tough to penetrate in. It takes anywhere between 3 to 10 years to get one registration. The average number is about 6 years, and the typical registration cost for one product is about 4 to 6 million euros in Europe. So it's high entry barrier in terms of capital requirement because it requires to spend a lot of money in getting registrations, but then also the duration of after which one can get a registration can be quite arduous. Long-term financials, if you look at Sharda, the 10-year growth rate has been sales growth, profit, cash flow, everything has grown at around 18%. Their working capital has also been in control. They do more or less around 100 days of working capital, like that's their working capital requirement. Recently, like in starting FY18, when the China pollution problem started happening, Sharda faced a lot of pressure on the gross margins. This was first of all because there was pricing increase from Chinese suppliers. Sharda has 100% or 97% sourcing from China. And this was really reflected in their gross margins. At the same time, there was a trade war going on between US and China, where US imposed imposed duties on agchem imported from China, as a result of which we can really see that they used to do 35% gross margins and it really went down to 30%. This then slowed down into EBITDA and PAT margins. And this also led to valuation re-rating. So Sharda was listed in 2014 and they had the first phase, which was much before US-China trade war, where they used to trade at somewhere between 2 to 3 times sales. And after the trade war, once their gross margins started shrinking, the valuation got derated. What has been changing recently is in FY22, the growth rate has been very strong. So in the last 5-6 quarters, they have been growing at 25% plus. So the 9-month FY22 growth has been more than 64%. And also the trade barriers are now getting lifted. Very recently, this was about 10 days ago, that US now is starting to exempt tariffs on Chinese products. So the trade war time is it seems that US is going much easier on China. So the trade level duties that was there, it's decreasing and it's going off, especially in agchem products. And this should be huge positive for a Sharda Cropchem because they procure all their manufacturing, all their technicals and formulations from China. And also, Sharda has a very rich pipeline of products. Uh, Growth was never a problem with Sharda anyway. Their promoters are very growth oriented. The registrations in FY21, they have around 2,500 registrations and more than 1,100, which is in pipeline. So at different stages of approval. So also in FY22, because of supply chain disruptions, Sharda could actually garner a lot of market share. They also increased the US customer base by 25 to 30%. And Sharda is very reasonably valued. On trailing numbers, they are 18 times earnings, 16 times if you just look 1 quarter ahead. And on an EV/EBITDA basis, they are 8.5 times. So it's definitely not very expensive company for the kind of growth that they are showing. And if you just look at a very long-term PE chart, there was a derating after Chinese issues. And the trailing PE is still much lower than what they had in 2015, 2016. Risks to this is, I'm not completely sure how scalable the technical or AI manufacturing is. PI Industries has shown that it's quite scalable. Most of the companies right now are doing 200 to 400 crore sales, and PI is already doing 3,600. So like 10x scalability is at least there. So for the next 2-3 years, scalability shouldn't be an issue. One key question is China still controls majority of the market. What if this China plus one reverses? What if China starts supplying products at much cheaper prices? And also India imports 40% of the raw materials that go into these technicals from China. What if China increases the prices to make Indian industry uncompetitive? So that's like my presentation. Among the stocks discussed, I have invested in Sharda, Punjab Chemicals, and PI Industries. I don't have any transactions in these stocks in the last 1 month, and I've been holding PI for 4-5 years now. Punjab for less than a year, and Sharda also for less than a year. And you can find my detailed portfolio. And I'm not a registered analyst. And now I'll be happy to take questions. Was I on time?
I mean, we started 5 minutes late. It's fine.
Okay.
How is the inflation? Sorry, go ahead.
Okay, Harsh, thanks. Yeah, really comprehensive in the time. Just a couple of questions actually. Two things is, the tailwinds. I mean, is it essentially a China plus one because of which there's like so much of excitement in this sector, or is there any other sort of tailwinds for this? That's my first question. The second one's related to ESG. I mean, does this sector sort of get affected because of ESG criteria, etc.? I mean, are there some limitations for this particular sector per se?
So the first question about excitement, in terms of, so we should segregate excitement from an industry landscape and from a stock market landscape. So in terms of stock market landscape, I don't hear so much about agri-chemical space as being China plus one. So the current narrative of China plus one is really attached with chemicals, and it's not really attached with agchem. Maybe we every now and then we hear about PI Industries, but that's pretty much it. I don't see a lot of work on other companies, but from an industry positioning, yes, there's lots of excitement. And in the last 1 year, we had like 3 new IPOs of agchem companies. So India Pesticides came up with an IPO, Hiranma came up with an IPO, and I think there was, so at Best Agro wasn't an IPO, they acquired another company and transferred their business, and they renamed it Best Agro. So there's definitely some excitement in terms of that. Everyone is putting up capacity, and that's mostly because growth is very strong. And the reason for growth being strong is China really accounts for 75% of global technical market. So even a 5% shift from China to India means India doubles. And this is also not a narrative. This is just in numbers. Like we can see the agchem exports data, and we can look at it for all the companies. And even on this slide, we can see that there are companies growing at 20 to 50% CAGR in the last 3 to 5 years. So growth is very strong. About your point on ESG, first of all, we cannot live without food. We just realized we also cannot live without coal. So ESG, how much of it is coming from people who want to write more research reports on it, I don't know. But there's one shift that's happening from chemical pesticides to biopesticides. And this market is still nascent. So biopesticides, I think right now accounts for 4% of the global pesticide sales. So it's still very small. But it's also a very nascent market. Nobody really knows. So it's like creating a new market. There's much more written about biopesticides than how much companies can sell it. But it's an interesting thing to look out for. Most of the Indian companies who are growing, they are still selling chemical synthetic pesticides, and that too off-patented. So they are selling products which were invented 50 years ago. But there's definitely a biopesticide shift happening. Like if you read Sharda Cropchem's annual reports, they have been talking about this for 8 years now. Since the IPO, every year they have like 3 paragraphs on biopesticides, and still they have less than 1% of sales coming from it. So I don't know how much of it. And I also come from an agri. So my bachelor's was in what was my bachelor's in? Yeah, agricultural engineering actually. So in IT Kharagpur, I studied agricultural engineering. One thing which was very clear about organic farming was there's much more buzz about it, and it's not scalable to the level. So the biopesticides are not as efficient as a chemical pesticide, but then you kind of pay in terms of soil quality or pH level of the soil over longer periods of time. But there are better ways of dealing with it. Anyway, like this is an interesting space to watch, but we can always hear narratives on biopesticide and how that will take over the world. I've been reading it for 10 years now. I've not seen much.
Yeah. So it's sorry, a small extension to that. So what I was meaning in terms from an ESG perspective was that, I mean, see, I don't know the space so well, but I mean, are there any limitations for institutional investors not to invest in this because of ESG criteria, and which because of which you may not look at I mean, because of which you may have limitations in terms of P rating or stuff like that? So is there any limitations?
Yeah. So I would invert this question and ask you something. Did ESG limit institutional investors from investing in specialty chemicals?
Yeah. So I won't know, but so certain spaces we know, for example, where there are limitations, and so so my question was, I would know about specialty chemicals, but here, I don't know. So I just
in terms of environmental compliance, it's the same as a chemical factory. At the end of the day, pesticide is also a chemical, so it's the same as a chemical factory. There are REACH compliance, which all the companies that I've listed, more or less, everyone is REACH compliant. So it's not as bad as a coal, I would say, or a tobacco, but it's not as green as a IT. It's somewhere in between. It's a chemical but yeah, institutions invest in this theme. API industry has a very high institution holding, and they manufacture chemicals. So it's a chemical manufacturing at the end of the day. But in terms of ESG, it's not a coal, but it's not an IT. So somewhere in between. It's a chemical manufacturing at the end.
Yeah, thanks.
Yeah.
Hi, Harsha, Sandeep here. You mentioned that there is a big dependency on monsoon. Do we have any idea of the dependency on the food prices and the usage of these chemicals and insecticides?
So there are two different questions here. So the first is the dependence of pesticide sales on monsoon. So if you have a good season in terms of rainfall, in terms of monsoon, then obviously the farmer will buy more pesticides because they are more excited. In terms of the impact of food prices, so higher food prices or higher inflation is generally beneficial for pesticide consumption because it means more money in the hand of farmers. Higher food prices is a positive for all agrichemical companies, be it a fertilizer, a seed, a pesticide. And generally, this whole sector is much more dependent on monsoon. So in years with good monsoon, generally the sales are very good. In years with bad monsoon, the sales the sales go down. So the dependence on monsoon is much higher than anything else that I've found so far.
Right, Harsh, just a follow-up question now. With the current Russia-Ukraine situation, they are one of the big exporters of wheat. They combined both of them around 20% of the wheat exports. So the general expectation is that the food prices will go up. But on the other hand, they are also big exporters of fertilizers, and that is getting impacted, which means fertilizer prices may go up, or we may have shortages, and the food prices may go up. How will that link to pesticide or insecticide?
So we can see this year what's happening. So there is a clear shortage of fertilizers this year. And that's because I think Ukraine accounts for 10% of global fertilizer supply. And they are into DAP fertilizers, which are less bulkier per se. So all the Indian fertilizer companies have had a field day because there's just a global shortage of fertilizers. So everyone is having a very good year, because at the end of the day, if you have a good monsoon, you will find ways to put fertilizers in your field because you want to optimize your output. So all the fertilizers company have benefited. The effect on pesticides is the next step. So the domestic pesticide sales this year hasn't been a bumper season. So FY21 was a bumper season because there was lot of money in the hand of farmers in FY21. The monsoon was also good, and there was lots of government support that happened in FY21. And COVID didn't affect the rural economy so much, at least in the first wave. So they are already coming off a very high base. So the Indian market is not growing that much. I think this year the Indian market is growing at 8 or 10%, somewhere around that, the pesticide market. But the export pesticide sales, every company has been knocking it out of the park this year. Like the 9-month FY22 numbers, all the pesticide companies which I know have grown at more than 15%. And this is mostly volume-led growth. So it's like they're selling more of their own products. And then they're also benefiting from higher price realizations, because this year there has been shortages in everything. And as a result of which the prices of food is higher, which is trickling down to pesticides. The prices of energy is higher. So energy price higher gets translated into pesticide prices, because energy is a huge component of pesticide manufacturing. In general, inflationary times are good for these businesses. Did I answer your question actually?
No, thank you, Harsh. That is the line of thinking I have, is if there are shortages across the board and inflation being high, if they are able to pass on that, then yes, they are in a sweet spot, so to say. Yeah, thank you.
Yeah, hi Harsh, Simrat this side. So just have one question. So how do you see entry barriers in this marketing business beyond domestic side or on the global side? So is it the case like in the pharma side we have US generic manufacturers which face pricing pressure? So is that the case here as well?
So we can look at this whole value chain. The highest entry barrier business over here is that of global marketing. So this requires having a very large global footprint, where you have to have relationship with global suppliers, and it's also very hard to penetrate regulated markets because the cost of compliance is very high. Although there is no US FDA kind of an authority here, however, the cost of registering products is super high. So in some ways, it's better than pharma because there is no FDA. So there is not a lot of problem on compliance. So most of the compliance is ensured by your customers rather than by the country in which you are selling it. So the country would not send people every now and then to check your factories, but your customers might, especially if you're in a B2B business. So global marketing is one, which is very high entry barrier. And almost a lot of companies in India have burnt their hands because they wanted to become global marketeers, and only one was successful, which was UPL. Everyone else had to trim down that business because it's very hard to get in. The other high entry barrier business is patented molecule scrams. So developing molecules with innovators and then manufacturing it at scale for them. This is also a very, very high entry barrier business because it just takes a lot of trust of an innovator to trust that their $1 billion will not be thrown away because the same, like the Indian guy will sell the same product to another market at a cheaper price. That's something which nobody wants. So that is a very high entry barrier business. And that's also shown, like only PI has managed to scale that. I think the second biggest from India is probably Punjab Chemicals right now. Although they are still very small and they are not that much into research so far. So this is, and then when it comes to generic AI manufacturing, the entry barrier over here is capital and process research. So this is very similar to a US generic pharma manufacturer. The expertise you can bring in over here is money by putting up factories. So that factory require money. The machines you put in that factory requires money. So one is capital, but the second one is process efficiency. So what are the chemistry processes on which you have expertise? And if you stick to expertise and you kind of get better at that process, you start becoming the lowest cost producer. So the generic AI manufacturing is really a low cost game. And this is why China is so good at it, because they built their efficiencies around scale. So they just put up lots of capacity and they manufacture in bulk. So they gain most of the competitive advantage by taking in advantages of scale, whereas Indian companies do not have that kind of capital funding behind them. And also the return that you expect from a Chinese company is much lower because they are cross-subsidized by the government, whereas that's not the case in India. So I've studied a lot of Chinese agchem companies. They do 8% to 10% ROCEs, and they're happy with that. If an Indian company does that, like they would not be ever able to raise capital with that kind of return ratios. So the Indian companies have to focus on process efficiencies because they cannot just build very large scale and expect that they can be the lowest cost producer, because we cannot just do that. So the generic game is very similar to generic pharma. The only thing is it's less competitive than generic pharma, because in generic pharma, there are a lot more players than in generic technical manufacturing. So that's the main difference. So I would say like generic pharma in 2001, when Dr. Reddy was becoming big, is where generic technical is right now. So it's still very small.
Got it. Thank you.
Harsh,
I- I-
let's stop the questions and move over, because I mean we
Yeah.
want to stick to time. We can take the questions after some minutes talk. Is that okay?
Yeah, I'll stop sharing. We can move to the next presentation.